Alright, pop quiz. In which year was the electric vehicle invented? Well, there's no one answer, but listen to this. In 1828, a Hungarian priest created a small model car that was powered by his newest invention, an electric motor. In 1835, a Dutch professor built a small scale electric car powered by non rechargeable primary cells. And the first known electric locomotive was built in the year 1841 in Scotland, which was the 7-ton monster that could haul a load of 6 tons at 6.4 kilometers an hour for a distance of 2.5 kilometers. Of course, we've come a long way since then in terms of size, comfort, speed, mileage, and efficiency. But I'll say the entire 1900s is when electric vehicles went into a state of cryogenic slumber, and it's only now, due to climate change and the questionable sustainability of hydrocarbon based transportation infrastructure, that EVs are getting the attention they demand and are showing a resurgence. In numbers, 14 million EVs were sold last year in 2023, and figure this, EV sales in Scandinavian countries has already crossed the 50% mark, with 93 out of every 100 vehicles sold in Finland being an electric one. The EV story in India is more recent, let's say 2017 onwards, when this trend that started with e-bikes is now very much visible in e-rickshaws, electric cars, e-buses, etc. As the sector continues to show tremendous growth and EVs are closing in on 5% of overall vehicle sales in the country. With more than 1 lakh electric vehicles being registered on the Vahan database, I'll say a good part of India's future depends on its EV success, with the country being the most populated, one of the most polluted, and in spite of the advances made, in my opinion, the infrastructure planning and execution in our cities is still very much leaky. Therefore, the opportunity is big, and in this video, we'll draw more insights into this mega trend, which includes the tailwinds, consumer preferences, the government support to the sector, etc. And specific to investing, we'll focus on this newly launched index, the Nifty EV and New Age Automotive Index, which has done exceptionally well over the past year as we understand its construct, suitability, performance, risk, etc. Actually, I'm surprised there aren't many fund houses that are working on this index. And in that context, I'd like to thank Groww Mutual Fund for firstly participating in this theme and also for sponsoring this video. Let's begin. Okay, so let's start with opportunity sizing, and the electrification of fleets is already upon us. From barely 0.3% in 2020, we're now at a weighted penetration rate of around 5%, which is projected to go up to 30% by the year 2030, by when India's annual EV sales is expected to touch the 2 crore mark, with most of it coming from the sales of two-wheelers and three-wheelers. With vehicle sales anyways growing at 8%, and with the shift happening from petrol and diesel fuel vehicles to electric ones, there's likely to be no dearth in demand for the next few years, which for any investor is a big plus point. A big driver of this initiative is, of course, the government, and not just ours, but governments all around the world, with this common objective of phasing out vehicles that run on hydrocarbons over the next 20, 25, 30 years. The Indian government too has been significantly supporting the EV sector under its various initiatives, which augurs well for its future. For instance, under the Electric Mobility Promotion Scheme 2024, a sum of 500 crores has been allocated to accelerate the adoption of electric two-wheelers and three-wheelers. A 5,790 crore subsidy has been granted to EV manufacturers for the sale of 13 plus lakh vehicles under phase 2 of the FAME India scheme. There's a PLI scheme for advanced chemistry cell battery storage at an outlay of 18,000 crores. On the 15th of March, the government approved a new $500 million worth EV policy, offering a range of incentives to global EV companies to establish their manufacturing hub in India. And in the recent budget, the waiver of import duties on 25 minerals, including lithium, is expected to lower the manufacturing cost of batteries, which, by the way, is like 40-50% of the cost of an EV. So this removal of duty can bring down the cost of manufacturing an EV by as much as 20%, leading to a reduction in the price of the EV, which can consequently boost the demand for it. Actually, I want to go back to the last point, the one on EVs getting cheaper. And it's an important one because although the manufacturers want it, the environmentalists want it, the government definitely needs it, but then it should also make economic sense for people like you and me, right? I say this because one of the big impediments, at least for now, is the high cost of an EV at the time of purchase. As we see here, it's a good 70-75% higher than a petrol-run scooter. But then when we apply the cost of fuel, maintenance, battery replacement, residual value, etc. over an 8-year period, the e-scooter shows a saving of 30 to 35%, making it viable for the Aam Aadmi and Aurat. Understandably, these numbers do vary depending on our assumptions around cost, resale value, electricity prices, the cost of crude, etc. But generally, and per a report by Bloomberg NEF, the total cost of ownership, the TCO for EV two-wheelers and three-wheelers, is already better than ICE, that is internal combustion engine vehicles, which is great news, while the TCO for EV small cars is lower than the petrol variant but is still slightly higher when compared to CNG small cars. Of course, as the technology improves, as the cost of making batteries reduce, it's very likely EVs will become even more affordable, which, as per this article, is just 3 years down the road. In that very context, I should add the fact that the price of battery cells have been softening over the months, which has actually allowed many Indian companies to pass on these savings to their consumers. For example, TPEM, which is a subsidiary of Tata Motors, has reduced prices of its EV offerings by up to 8%, which is up to 1.2 lakhs. MG Motors has cut EV prices by up to 1 lakh. The two-wheeler manufacturer Ather Energy has reduced the price of its entry-level model, the 450S, by 20,000 rupees, and so has its competitor Ola Electric, which has slashed the price of its S1 range scooters by rupees 25,000. Right, so for a sunrise industry that's forecasted to grow to about $114 billion over the next 5 years, it's a bit surprising that there aren't any funds that are dedicated to this theme. I mean, if said in a more Indianized way, a $114 billion comes to rupees 1 lakh crores, which certainly is no small change and probably what prompted the National Stock Exchange to launch the Nifty EV and New Age Automotive Index in May of this year. This is India's first ever electric vehicle index and aims to track the performance of companies that are part of the EV ecosystem or are involved in the development of new age automotive vehicles and related technologies. This last part of the statement is rather interesting as it explains the importance of the EV ecosystem, the entire value chain, which not only includes OEMs like Tata Motor, Mahindra Electric, Ola, Ather, MG, Electra, JBM Auto, Switch Mobility, etc., but it also includes battery manufacturers like Tata Chemicals, TDSG, Amara Raja Energy and Mobility, Exide Industries, etc., electric motor manufacturers such as Sona Comstar, Varroc, Tata Autocom Systems, and others, charging infrastructure providers like Exicom, ChargeZone, Sun Mobility, Magenta, fleet operators namely Zip Electric, Blue Smart Mobility, Yulu, Lithium, component manufacturers like Minda Corp, Sona BLW, Schaeffler India, Bharat Forge, etc., chemical manufacturing companies including Himadri Specialty, Tata Chemicals, Gujarat Fluorochemicals, and even IT companies like Tata Technologies and KPIT Tech, who offer a range of software solutions to the automotive industry. So it's an entire ecosystem, and I guess over time, many of these subsectors will be big enough to be classified as an industry onto themselves. Take charging infrastructure as an example, and as of February of this year, there were some 12,000 charging stations across the country. But this isn't enough. It's not enough by a fair distance, and per a recent report by the CII, the Confederation of Indian Industries, our country needs a minimum of 13 lakh EV charging stations by the year 2030, which means we are less than 1% of where we need to be. I'm sure you get the point, and as an instrument that visualizes the entire electric vehicle ecosystem, the Nifty EV and New Age Automotive Index does participate in all of this as it offers exposure to a diverse portfolio of Indian companies within the extended EV industry. Now, from a structure standpoint, the stocks that form a part of this index are always selected from within the Nifty 500. But interestingly, and I've not come across this in any other index, the stocks are then split into 4 distinct groups. Group A includes companies that are manufacturers of two-wheelers, three-wheelers, four-wheelers, electric passenger and electric commercial vehicles. Group B has the manufacturers of batteries for electric and new age automotive vehicles. Group C consists of companies that are either into component manufacturing, or they are raw material suppliers, or they provide advanced automotive technology. And finally, there is Group D, which includes companies that fit within Group C and are also a part of a PLI, FAME, or SMEV program. This grouping is an important part of stock selection, and the Nifty EV and New Age Automotive Index includes all stocks forming part of Group A and of Group B. It selects the top 5 stocks from Group C and an additional 5 stocks from Group D that are not selected in step 2 above. In terms of weights, all stocks belonging to Group A are capped at 40%, with the weight of each stock capped at 8%, while all other stocks are capped at 4%. This can be seen in this table here, where the vehicle manufacturers from Group A, so Tata Motors, Maruti Suzuki, Mahindra and Bajaj Auto, have a weight of about 8%, while the rest of the companies are at around 4%. Presently, the Nifty EV and New Age Automotive Index comprises of a total of 33 stocks, and it's a list that is reconstituted on a semi-annual basis and rebalanced every quarter. I also looked at the performance of this index, and what one should know is that unlike many other indices, which generally have a base starting date from April of 2005, the Nifty EV and New Age Automotive Index starts from the 2nd of April 2018 with a base value of 1000 points. Since then, the index has done exceedingly well with 22.3% in returns, with a more accelerated performance coming in recent years, and especially the past 1 year when this index delivered a gain of 61.6%. In terms of risk, the Nifty EV and New Age Automotive Index is definitely high risk, as it leans on a particular industry, the automobiles and auto component sector, which currently accounts for 69% of this index, followed by information technology, chemicals, then capital goods, and finally oil, gas and consumable fuels. In fact, the sectoral skewness shows up in the index's annual performance as well. For instance, 2018 and 19 were really bad years for the Indian automotive industry, and while this index faltered, the broader index, the Nifty 50, was on its way up. But boy, did the tables turn, and especially in 2021 and 24, when our EV index delivered 64 and 71% respectively, while the Nifty experienced a relatively sedate growth in its 20s. In terms of volatility, the index has a 5-year standard deviation of 20.58%, which I think is par for the course, and in terms of valuation, the index currently stands at a P ratio of 35. So that was a broad overview of the index, and as I said earlier, there is not a single index fund that is taking advantage of the ongoing transportation/electrification opportunity. But that changes now with Groww Mutual Fund coming up with its latest NFO, the Groww Nifty EV and New Age Automotive FOF, that is now open for subscriptions, and the NFO closes on the 7th of August. This offering by Groww will be a passively managed fund with the scheme investing in a basket of stocks in the same proportion as in the Nifty EV and New Age Automotive Index, which will also serve as the scheme's benchmark, which means the investment strategy of this passively managed fund, and therefore the role of the fund manager, which is Mr. Abhishek Jain in this case. So his role would largely be predicated around reducing the tracking error to the extent possible through regular rebalancing of the portfolio. Some more details: the scheme will be allocating 95 to 100% of its assets in units of the Groww Nifty EV and New Age Automotive ETF, or a similar ETF tracking the Nifty EV and New Age Automotive Index, while 0 to 5% of the assets will be placed in debt and money market instruments for basic liquidity purposes. On a standard SEBI riskometer, the fund is ranked very high risk, and that's understandable given the fact that there is very high exposure to equities here, and secondly, there is concentrated exposure to the EV and new auto segment. Investors can start investing from as little as 100 rupees in a monthly SIP, while the minimum lump sum investment is kept at just 500 rupees. The scheme has an exit load if units are redeemed within 30 days from the date of allotment, which goes down to 0 if the redemption happens after 30 days. Specific to taxation, the Groww Nifty EV and New Age Automotive FOF is classified as an equity fund for tax purposes as long as its equity exposure is above 65%, which is anyways the intent here. And finally, what is standard practice, but I'll still say it, the scheme does not give any guarantee on returns, and the performance, okay, listen carefully to these words, the performance is subject to the vagaries and vicissitudes of the markets in general. ये part Shashi Tharoor ने लिखा था क्या? Right, so let's recap. EVs are likely to capture 30% of the Indian vehicle market by the end of this decade from the current 5%, which translates to a lot of growth with some participating companies potentially becoming future multi-baggers. The Nifty EV and New Age Automotive Index that we discussed in today's video wholesomely participates in the sunrise sector by capturing the entire ecosystem of companies and industries that are involved in electric vehicles and other new age developments like hybrid vehicles, fuel cell, automation, etc. The total exposure to automobile manufacturers is capped at 40%, which means 60% of the scheme's allocation is towards segments like auto ancillaries, battery, chemicals, etc., which is not only diversity, but in my opinion, has a higher growth element to it. Although there's sectoral skewness and therefore very high risk, the index has performed quite well in its 6 odd years of existence. We investors can participate in this passively via the Groww Nifty EV and New Age Automotive FOF, which is open for subscriptions now, and the NFO will be there until the 7th of August. And before you invest or consider investing, do consult your financial advisor and do read the scheme information document carefully, a copy of which is available in this video's description. Electric vehicles and advancements in automotive technologies are evolving rapidly. They are here to stay. And now that we have an investing vehicle, it is also the most opportune time to explore this promising sector. I sincerely hope you found today's presentation useful and informative. Thank you for your time. Do subscribe to my newsletter, and I'll see you very soon. Until then.